Double entry systems. Double entry systems. In the double entry system, each transaction must be recorded with at least one debit and one credit, and the total amounts of the debits must equal the total amounts of the credits. The system is based on the principle of duality, which means that every economic event has two aspects that balance each other. Let's discuss accounts. Accounts are the basic storage units for accounting data and are used to accumulate amounts from similar transactions. An accounting system has a separate account for each asset, each liability, and each component of stockholders' equity, which includes revenues and expenses. An accounting title should describe what is recorded in the account. Rules of double entry accounting. So the double entry system follows two basic rules. 1, every transaction affects at least two accounts. 2, the debits must equal total credits. For every transaction, one or more accounts must be debited or entered on the left side of a T account, and one or more accounts must be credited or entered on the right side of a T account. Rules of double entry accounting. Let's keep in mind the accounting equation. Assets equal liability plus owner's equity, ALO, or stockholders' equity. So if a debit increases assets, then a credit must be used to either increase liabilities or stockholders' equity because they are on opposite sides of the equal sign. Similarly, if a credit decreases assets, then a debit must be used to decrease liabilities or stockholders' equity. And then we see here the increases or decreases for both assets, liabilities, and stockholders' equity. As you can see, assets increase on the debit side, whereas liabilities and stockholders' equity increase on the credit side. Rules of double entry accounting. So dividends and expenses are deductions from stockholders' equity. So transactions that increase dividends or expenses will decrease stockholders' equity. And here you can see the expanded version of the accounting equation that includes for stockholders' equity, common stock, retained earnings, dividends, revenues, and expenses.